So we've talked a lot about the underlying rates.
Yeah.
Let's talk about credit. Let's talk about supply. Let's talk about spreads. Those are the big things everybody always asks about. So from a supply standpoint, same survey, 88% of respondents say supply is going to be higher next year. Talk to me about your outlook for supply. Why?
I'm aware that it's a presidential election year, and we're dealing with a very stringent FTC from a regulatory perspective. But that still doesn't limit people's ability to do smaller deals, and those smaller deals could rapidly add up to a very big critical mass for the market. And I think corporates are desperate to do incremental M&A. I think the market backdrop right now is helping to facilitate that, and I think we're going to see that. And I think that's going to lead to higher than expected numbers.
Let's also keep in mind, Moshe, two things. Surprisingly, corporates are already up 46% year to date in the first 2 weeks. That's only the first 2 weeks, but that may be a sign of things to come, because you also have this year underlying maturities. We're hitting one of the bigger years of underlying maturities this year. We're going to hit the two biggest years in 2025 and 26, and you might see some of that pulled forward. And we are entering, starting this year, the largest 5-year period of maturities in the IG credit markets. So I have a feeling that the market's going to be looking at higher and higher supply over the course of the next couple of years, potentially, as it tries to refinance, if it's still needed, a lot of this debt that's maturing. That gets us to spreads, right? We've talked about underlying rates. We've talked about supply. Spreads. We all know that the spread rally that occurred at the end of last year, the last month and a half, call it, that came into this year, we continue to maintain plus or minus a basis point off those index spreads. We went and surveyed accounts on spreads. 79% of them said we're going to be wider by June 30th, 2024. That's 6 months away. That spreads will be definitively wider. They don't see the upside in spreads. Seems they're playing mostly for the upside in rates. Where do you think spreads are going to be, especially with your constructive economic outlook in terms of what corporate earnings might be and how the environment might be?
The big picture narrative that we got out of this survey was that rates are going to be lower and spreads are going to be marginally wider. So it's basically sticking to the potentially, a real slowdown in the economy, but a non-recessionary slowdown in the economy. That's the narrative going on with our investors. One thing that would support their argument about spreads being just modestly wider is just given where absolute levels are. But you're right, given our view about the economy, I would take a little bit of a different tact on it, because I don't think you're going to see the rate move that a lot of investors are anticipating. Likewise, I don't think you're going to see that spread move either, with the big and massive geopolitical caveat that I spoke about earlier.
Right, you believe there's going to be a buy the dip mentality here on spreads, right? We've talked about this before, that we can only really widen so much unless there's something fundamentally different in the world.
I think you see a buy the dip in virtually every single asset class, because the Fed and the fiscal authorities the fiscal authority have been greasing the wheel with that spigot on full throttle since COVID. And the Fed is basically adding to it right now by pre-signaling a rate cut, which we all know the markets tend to accelerate very quickly. So it's as if the Fed has already eased.
I mean, so Moshe, we look at this whole picture, and we've talked about several times, you mentioned where we are currently in the market. It's been such a good spot, but there's a couple of individual things that we're talking about, right? We have, the curve hasn't really rationalized yet. And so issuers, if they want to go today, cost of carry is still the lowest, some of the lower levels it's been in a while, right? We haven't gotten to that positive slope in treasuries where the cost to take debt on early, it's much less expensive now to do that and refinance something that's out 6 months, 7 months, 8 months. The other thing that's happened too is we have the duration bid, right? And while still people are buying 30 years as they were at the close of the year, we still see that bid today. But what we've seen now is a short end bid. 2s through 5s have really performed well for us in the new issue market. In addition, we've had a couple of floaters done this week for decent size, right? We had 2-year floaters print for 2 of our captive finance companies that went extraordinarily well. And that to me means there's also a little bit of a shift in maybe everybody doesn't believe rates are going as low as they're going to go or going as fast as the survey says they are. And, we do have that wall of callables that was done last year, the 3 non-call ones. So we're going to get to a point, if rates stay here, right, what happened? The swaps get called, right?
Swaps get canceled and the bonds will likely be called. And then the question is, what do they refinance that with?
It feels like if you are buying floaters, and you don't think rates are going to be coming down that fast, there's the possibility that that bid is going to come back in the market for those 3 non-call ones if people become less convinced that we're going to be going down in rates as fast and as far as people think they are.
I agree with that.
This is going to be a lot of fun going forward. We've had a great time here the last 2 weeks. We love executing, you know that. And so looking forward to continue to supply and helping our clients. So I'm going to give you the last word and ask you, sum it up as good as you can in a single sentence. Advice to issuers, what's it be?
I believe we're pricing uncertainty in a very uncertain world. So if I was a borrower and I had a capital raise to do in 2024, I'd be seriously consider accelerating that financing into the current quarter.
I appreciate the time you spent with me.
You're welcome.